Okay, so yesterday, guys, when we were talking, we basically were talking about market structure and we got in deep with market structure. Okay, as we got in deep with market structure, we ended where we had a bearish scenario and a bullish scenario. And for today, what we are going to be actually talking about, we are going to be talking about imbalance. Right. The last time that I talked about imbalance, a couple of guys that didn't quite get it because it was a bit quick and it wasn't a topic on its own. It just came in. Right. So basically, an imbalance, the best way that we can describe an imbalance, guys, is I'm trying to find the perfect words. So basically, the perfect words that we can use to describe an imbalance is when, for example, there are more sales and buyers are not given a chance to buy, or there are more buys and sellers are not given a chance to sell or play in the market. Okay, so imbalances usually they are found when price is trying to run away from a certain position, or when price is trying to what can I call this? When price is trying to mitigate a certain position or to run away with price, with money, with value. Okay. So basically,
Sir Kuda,
okay.
the other day, the lesson on imbalance price,
Okay.
you told us that whenever there is an imbalance price, in future, the price has to come back to that level and cover that gap, right?
Yes, yes, yes.
So always it has to be like that, or in some cases, it can never come back.
Right. Can I get to that point as I talk? Because sometimes we can find an imbalance, and that imbalance cannot be filled like instantly. Maybe we can feel an imbalance after a week, we can feel an imbalance after a month, we can feel an imbalance after 2 months. You understand?
Okay, because I was checking the Bitcoin chart. So I found an imbalance on Bitcoin at $14,000 price range. There was a big gap which has not been covered yet. So this is why I was asking, is it possible for Bitcoin to go back to that price and cover it and come back?
Yeah, it's very possible.
Okay.
Okay. So these imbalances, they are running away with, we are saying they are running away with price, right? And how these imbalances are going to be looking like is, let me draw a candlestick scenario here. I'm now fully focused. Here, sorry, I was a bit sketchy when I was talking because there were some people who were sending me messages from the group on my phone. Okay, so what we said is healthy price action is when we get these 2 weeks, the tail from here and the tail from here. There is no gap between these two, right? This is what you call healthy price action. Sorry, I'm not writing right. Sorry, this is what you call healthy price action, whereby there is a balance of sellers at a certain area and a balance of buyers at a certain area. Okay. Now, When you see your charts or your candlesticks behaving this way now, now we have what we call an imbalance. Price is not balanced here, and price is to get filled, right? So don't worry, I'm going to be teaching you on how to know if this area is going to be filled soon after it's created or whether it's going to be filled after some time. I'm going to be teaching you that. So don't worry about some questions that you have in your heads right now. But for now, keep it in mind that we call this an imbalance, right? So how the charts usually behave when we have an imbalance is they behave this way. We are going to be knowing why they do this in a bit. So don't worry. When the markets have an imbalance like this, they tend to come back to that area and then fall, right? Okay. So for some guys who already know how to trade these imbalances, traditionally we know that we put a Fibonacci here. We put a Fibonacci here from this point to this point, and then we take the 50% level and then whenever price hits the 50% level on the Fibonacci, we enter a sell and then wait for the price to what? To drop with our stop loss above the 71% level. That's how we traditionally trade these imbalances. But as time goes on, you are going to see that our imbalances, we are going to be trading them maybe at this point or maybe at this point. Why are we going to be trading them at this point? Because now I want you to watch this. I want you to remove all of this. Because now our area of interest or our real imbalance area, say we have a 15 minutes, say we have a 4-hour chart, right? You might see that if you look onto your 15-minute or if you zoom onto your 15-minute chart at this imbalance area, you're going to see that maybe price action was behaving like this, and when it reached this point, it just dropped and then started behaving like this. And so our real imbalance in this 4-hour candle might be this zone. And then maybe when you zoom on to a smaller time frame, say the 1-minute time frame or say the 5-minute time frame, you're going to see that maybe your chart your chart was going to let me change color. Your chart was going to look like this, was going to look like this, was going to look like this, and then at this point it dropped, and then it was looking like this, looking like this. So your real imbalance area is now reduced to this point. Do you understand? Is there anyone who's not getting it right now?
Yes, sir.
We are all understanding, right? So
Yes.
so
I was too
so the way that we trade these imbalances might be also time frame based, and we want to find the exact or the straight to the point real imbalance that we have. So what you have to do is you have to look from a bigger time frame, switching on to smaller time frames, switching on to smaller time frames, switching on to smaller time frames until we find our real imbalance area, which is usually around the 50%, around the 61.8%. Okay. So for a start, when you are trading this, we are going to be changing the concepts, but this works. You might want to discover an imbalance, right? Or areas where there were imbalances when you are on your own, and then you would want to take your Fibonacci, right? You want to take your Fibonacci from this point to this point. Say this will be your 100% on your Fibonacci, and this will be your 0% on the Fibonacci. We'll get onto the Fibonacci lesson, guys. So for those who don't know a Fibonacci right now, don't let it eat you right now. And then maybe this will be your 50%. So if you look quite good at it, you see that mostly a trade will come at the 50% and then fall, or the 61.8% and then fall. So as we go on with the course, we're going to be changing our rules, because sometimes you might find that as the imbalance fuels, it might go above a bit and then fall. Right. So don't worry about this one. For now, just keep this concept in mind, and then we'll talk about this one. Now, what we want to talk about now, knowing imbalances, these were very essential for us to know them first before we talked about institutions. We have what you call institutions. Right. And basically, institutions, they are what you call liquidity providers. They don't have a broker because they physically own the currency. Right. So we can have a block diagram that's going to look like this, right? That's going to look like this, right? It's not that good, but it's not about what I'm writing. So we have our liquidity provider here, right? After our liquidity provider, we have what we call our broker here, right? After our broker, then comes us retail traders. Sorry, quite bad there. Anyways, it's okay. I can repeat. So now we have our broker, right? After our broker, then there comes us retail traders, right? Retail trader. So you are going to find that liquidity provider provides the broker, and then the broker provides the retail trader. And when giving back the retail trader, the retail trader gives back the broker the losses. The broker gives back the liquidity provider the losses. Sorry, I had a slip of tongue there. So now these ones, they are guaranteed to make money even if we go in loss, the brokers. Why? Because they charge what you call swap. They tune what you call spread, and then they tune what you call commission. So basically in the market, we just contribute 5% of the volume in the market. So we are nothing in the market. We are close to nothing in the market. Why? Because this guy can move charts whenever he wants. This guy can make money. Even if you make profit, he makes money. Even if you lose profit, he makes money. Why? Because he's charging you all this. So basically, it's us against these two. But now, what we are more interested in is knowing how this guy works. right? How the liquidity provider works. Because the liquidity provider doesn't have a broker. They own physical currency and they make money by creating orders. So when the liquidity provider loses 30 million, he sells his contracts to someone for weight, or to another institution who's willing to buy them for 30 million in physical currency, right? So we have what we call now, we are now focusing on this guy, the liquidity provider. We have what we call now institutional funded candles. These are institutionally funded candles, right? And you can call these candles, for someone who might want to write notes, we may call these sell before you buy candles, or we may call them buy before you sell candles, right? So basically, I want to give an example here. So let's say we have a range that is 20 pips, right? And us, by having a range that is 20 pips, our price will be moving in this 20 pip range like this, right? And then all of a sudden, you see a 200 pip drop like this. This candle just came out of nowhere, from nowhere, right? And then you'll be like, I've been manipulated. I've blown my account. That's how you blow. Now, there is a candlestick that comes here. Let me put it in green. Before we even notice this whole drop. And then soon after this candle, we see this drop. Right. I'm sorry, I don't know what was happening there. And then, come on. And then soon after that candle is formed, come on. And then after that candle, you see this candle with a 200 pip drop. What is this candle? This is what you call an IFC, or an institutionally funded candle. So how this candle works now, so let's keep it here so that we 200 pips. So how this candle works now is institutions, they pump money in this candle and they pump money in this candle. So what they are doing is they are buying and selling at the same time, right? Why do they do this? They do this so that they go in their intended direction. So what might happen here is they might put 100 million or 1 million, let's say, in this candle here. They might put 1, 2, 3, 4, let's say they put 5, right? Here, let's say they put 1 million. This is 200,000. Let's say this is 200, and on top of that they put another 200. Here 200 until it reaches 1 million, just to form this candle. And as they reach certain pip count, they now put another 100 million, right? Closing this one, they now put another 1 million. Say 1, 2, 3, 4, 5. They put 1 million buying. Let me type here. So let's say they put 1 million to buy, forming this candle, this small candle here, and then at the same time they put 1 million to sell. What does this mean? This means when they put 1 million and let's say they reach 5 pips or 10 pips, it's a very big move. Right at that instance, they put another 1 million. Meaning that when they buy, this candle is buying for 1 million, and when they sell, this candle is selling for 1 million. But now, just because they want to sell, they have to start with a buy, so that the sell overpowers the buy. That's getting a bigger movement like this. Now, when they buy for 1 million, right? What does this mean? This means at the instance of buying, they already have a negative million, right? And when they sell, this 1 million is now compounding or getting into profit. But now what we have to keep in mind is they have this buy order that they created that's getting into loss, right? You understand? It's like when you open a trade, you can buy and then you can sell at the same time. But when your trade goes down, it gets into profit. When you sell, the sale gets into profit, but the buy gets into loss. So what they have to do is they have to let this sale collect money. This sale will be collecting money, getting into profit, and this buy will be getting into loss, right? And when they reach their desired movement, they stop, meaning that, say this sale is collected 10 million, right? And when this sale collects 10 million, let's say this buy is a negative 10. So they now close with a profit of 10 million. Here they'll be at break even. And now they have to wait for the trade to come back at break even. Meaning that this trade that was in loss for 1 million, which was in 10 million loss, when it comes to break even, they close it. How much money do they have now? They have a profit of 10 million. And then the charts continue to go their way. Do we
I'm
now?
shocked.
So just from this move, they make money. They make a lot of money because these moves are engineered. Remember, they also have to make money. Now, how are they making money now? They are now making money because you have put your stop losses here. Your stop losses are hit here. They are all orders here. They are all orders here. So they are collecting pips, hitting stop losses, collecting money and all. Right. Now, why do they come here? Why do they come back here? They come back here so that they don't close in loss, but they close in profit. Okay. So now we have to know that they inject buys, but just because they want to move in a sell direction, they have the capability of closing this buy position, it's negative 5 pips. But just because they know they have to collect more money, they let the trade run. Because they have more equity, their trade runs, comes back, plays with your emotions. You are now crying, I've lost money. Or you're now crying, I've been hit with a big candlestick. But what is this candlestick? You don't know what it is. It's an engineered candlestick. Right. So, now, just because we know what happens, we have to know that let me do this. We have to know that our candlesticks are going to be looking like this, right? So now what we have to know is we have, this is wrong. This is a bit wrong. I want to start here. Oh, come on. If you miss these Zoom sessions, I don't know. You are going to need God to help you, not me. Right. So now what you have to know is we have discovered that we get what we call an IFC, right? We have our IFC here. And remember the reason why we said they have to come back here. So by us knowing this IFC, which is the buy before you sell candle, we have to take note of where this candle closes and opens, right? So now they have to do a process, what we call mitigation, right? In this mitigation phase, they have to come back, close at break even, and then fall. Now our trade is running in the normal direction, right? Or in the way that it was supposed to run, right? If it is not an IFC, it's going to be looking like this. Sorry. If it is not an IFC, it's going to be looking like this. It's just going to be looking like this. And then it continues. There is no need for them to mitigate. Why? Because they don't have to close at break even, because they are not in loss. So we call this an organic formed candlestick, right? An organic formed structure, right? So when we are trading with these IFCs, what are we generally looking for? We are generally looking for price to come back up, right? And as price opens, this will be our first entry. As it hits the low of this candlestick, this will be our first entry. As it hits 50% of the IFC candle, there's another entry there, right? And if it has a tail, this is another entry. And our stop loss is directly or immediately at the open of this IFC candlestick here, right? So IFC for come back, mitigate, find entries at the wick, at the open of the body, or at the 50% of the body of the IFC candle. So now what you have to know is if this IFC candle is equals to, if our IFC candle is equals to 5 pips, then our stop loss is equals to 5 pips. If our IFC candle is equals to 10 pips, then our stop loss is equals to 10 pips. right? You have to really note this down, guys. Now, let me wrap this. Let me wrap all of this. So you might have a scenario of the, I want to show you now how these IFCs may appear. We can have a lower high there. We can have a lower low, right? Say our overall trend for this trade was a downtrend. An IFC might show itself up here, right? Right? It might show itself up here. Let me change color so that we can see the screen. Sorry, don't mind the colors. So in IFC might show up here. Remember, this is our lower high. Remember, this is our lower low. This is our lower low, right? And we can have an IFC playing out like this, mitigating from a zone, running away from a zone, then come back for mitigation, then for breaking the previous what? Previous low. And then we continue in our downward direction. So this is how an IFC might present itself, or this is how they can present themselves. Once you start knowing these moves, right? So keep it in mind that our SL will be here. This is where our SL will be, and our entry will be somewhere here, right? And this whole phase here, we call it what? Mitigation, right? So this is how an IFC might present itself in on our charts. And now what you have to know is we don't hunt for them, but we have to let them present themselves. Because if you hunt for them, then it becomes a very big problem. So we have to know that this is why these moves happen. These IFCs are made by banks, institutions. These are bank moves, right? The topic is quite big about IFCs, but as for today, this is what we can go and read on, research more on, and try to find this on our charts. I'll send you how IFCs look like on the charts in our group, specifically in our Telegram group, because if we send them on our WhatsApp group, some people won't be able to get the history when they join the group. Okay, so this is it for today. Thank you very much for attending our Zoom meeting.